All right, today we're going to talk about stop losses and how to place them. We're going to look at it from a short-term standpoint, so like a swing trade, and we're going to look at it from a long-term standpoint and how you can really make this process simple based on really what your risk tolerance is and how much you're willing to risk with each investment, short-term or long-term. So let's get to it. So this is NVIDIA's stock as of June 26. And as you can see, NVIDIA has been on a pretty wild ride for the last, well, 3 months or so. And so let's look at where we may have put a stop loss in for an order. And let's think more short term to intermediate term. So intermediate terms like 62 days or a quarter of the year. And so when I look at this, I am identify that there has been an accumulation phase here. And so let's block this off. Let's block this off and we'll say right about here, we can see NVIDIA sort of basically has traded in this range for a while. So this, I would deem it as an accumulation period. We saw an accumulation period here as well. So back in this area, and we had a breakout, a retest of this area again in that particular position. So let's say I got in, I noticed this was the accumulation phase. It's been trailing my 15 period moving average. That's my trade trend line. And I anticipate that it's going to move higher. So I put an order in right at the 15, and let's say I put an order in right there at the close of $144.17. So now I have I order there, and I'll put a horizontal line there as well, so you can see that. So let's say pick it up right there at the top end of that day. That's my entry point there. And how much am I willing to risk? And I guess this is a matter of what is your time frame. If it's a short-term trade, if you are day trading or you're more swing trading, you would probably look at this and go, the most I want to take risk at this point is maybe say anywhere between 1 and 5%. So I'd look at my entry point at 144.17, and I would put maybe my stop right down here in this area where there has been a level of support built in that area, and I'll make that red, and that's my stop. So that put me, I entered, let's say at 144.17. Okay, that's where I entered the order. My stop sits at 140.43. So I'm roughly a 3% stop loss there. Okay, so I'm doing that because one, I have confidence that it's built a base here, and that's where I put I suspect that this is going to hold up, and it's trailing my trade trend line and hasn't broken through that. So I feel safe with about a 3%, 3.5% stop loss right there. And I'll put a stop loss there. And next thing you know, it breaks out on the Tuesday, the 24th. I bought it on the 23rd, breaks out. And now I'm up in this area again where it closed at 155.02. Not a bad gig right there, right? And so if this is a swing trade or if this is a just a trade, you don't plan to hold it for more than say 15 to 20 days, I would put my stop there and let this go, let this run up. Now that's a stop loss. You put that in, it doesn't move with the stock. What I like is a trailing stop loss. So I have a basically a 3% from where I entered, and I put a trailing stop. And let's say I'm going to put my trailing stop at 3% below because this is more of a short-term trade. And as it moves up, the stock moves up as it has, it'll trail up with it. Okay. This allows you freedom. This allows you to put that trailing stop in at 3% below where you bought it at. It moves up and it will move up 3% with and trail up with it. Okay, so then if the stock, say 155 02, where it closed today, the 26th, that's the top. Then I'm sitting at 3% below that. So let's figure out what that price would be. So then I'd put my stop would trail up to 150.36. So let's just put it right there. That's where my stop is now. So it's trailed up with it. And we're going to make that yellow. So it makes it a caution. And so right now, what have I done? I placed my order. I picked up my order because I saw accumulation here. I saw support in the trade trend line, the 15 period, and I bought at the close. So this is Monday, the 23rd of June, and I bought there at a price tag of 144.17. So we got it there. It's moved up now. I'm at 155.02 as a close of business on the 26th of June. And my trailing 3% trailing stop loss has now moved up to $150.33. So if I get stopped out at 150.33, I bought it at 144.17. I've now made, let's just easy math, say $6. Or in this case, is that right? Yeah. Uh, yeah, $6. We made $6 on that trade. That's not a bad gig, right? Well, let's say instead we go, I don't want to, this is an investment. This is more than a trade, more than a 15-day period or 20-day period. But this is more of, I believe NVIDIA has gone through its rough time and it's made the staircasing move up. And now I believe it's going to move higher over the rest of the year. Okay, so it's more of a long-term trade. So what I may do is say I need a little elbow room in a sense. At 3%, I'm pretty high probability I'm going to get stopped out at some point. How do I figure that? If I'm using my trade trend line as my support, as this has run up since April 30th, and it's used the trade trend line sort of as the barometer to follow that. Chances are this is going to come back down at some point because we had a staircase or a accumulation, a move higher. It got rejected there, came back, touched the 15. Okay, moved back up, accumulated, and now has moved up again. Behavior is telling me that this is going to come down to 15. It's the 15-day moving average or the trade trend line. So I don't want to get stopped out of this. I think it's going to come down and it's going to accumulate and go higher, just as it has done since basically the mid May, and done the same thing. And I expect the same pattern to happen again. And then NVIDIA, fundamentally, to me, is a good company. It's a leader in the semiconductor world. It's probably going to be a leader for a long time. So maybe I don't want to get stopped out of here. So what I may do is increase my trailing stop from 3% to say, let's say 10%. Okay. Some people may use 7%. 10%, you get stopped out there. It's not the end of the day, but you do have to accumulate, have a bigger move to accumulate. But also 10% gives me some breathing room. So let's say on $55 or $144.17, I put in a, let's just say 7% stop loss. And that would put my stop loss at $134. Okay. So 134 puts me right about, let's make that color blue. It doesn't show up too well. Let's say my color is more of like a pinkish color there. And we're going to make it a little bit bigger because this is a long-term point of view. Okay, so I have a 7% stop loss from my entry point here. And I have that, and it trails with me to this point. So if I'm now at 155.02 and I'm running a 7% stop loss minus 7%, That's going to put me at 144.17 or 16, which puts me right back to where I bought it. Okay. So that is, uh, make it that color. I'll make it even bigger. So my trailing stop now, if I had bought at 144.17 back on Monday, the 23rd, and I put a 7% stop loss, my 7% stop loss now sits basically at where I bought it. That makes me feel better from a long-term standpoint. Now, I am close to my trade trend line, but my trend line is going to readjust and it's going to possibly move higher. So it's going to keep me out of this range potentially at 7%. 7% on a long-term investment to me is mildly conservative, but it protects me. And at this point, I'm now still, if I got stopped out at this point, if it went straight down tomorrow, and I got stopped out, I basically I'm even. I haven't lost any money. But if it comes down to the trade trend line, and the trade trend line now is 145.18, and let's assume it's not going to come straight down. Something bad would have happened, right? So chances are it's going to meet up right around 150.14 when it does come down to this area, most likely. And that's if that holds and the trade trend line is at 150 for 33, or yeah, no, one say 150 33, then I'm still in the clear. And that's a good thing. And it'll most likely accumulate as it's done back here and here, and I'll move higher. So that is two ways to look at this from a short-term standpoint and a long-term standpoint. So let's review very quickly. We see accumulation, this box of accumulation. It moves up, it tests the 15 here, and then accumulates again. We buy it back here at 144.17. And on a short-term basis, I put in a 3% trailing stop. And that puts me down here at the 139 or so range right here. Okay. And so stock moves up. My trailing stop on my short-term trade brings me up to $150.33. If it moves down the next 2 days, I get stopped out. I still made good money because I bought it at 144.17. I get stopped out at 150.33. That's a short-term perspective. If I'm in this for the long term, more than 62 days, 62 days is a quarter of the tradable days in a year, minus crypto. They trade 24/7. I put a 7% stop loss and it trails up. And at this point, if I had bought it on Monday, the 23rd, and it moves up to where it closed today at 155.02, my trailing stop now would be at basically at 144 17 or so. And so I'm basically even now. I'm covered. I believe that this will come down on a long-term basis towards the 150.33 range, most likely. Go sideways, build some accumulation, and start moving higher again. Outside of a headline event, outside of somebody doing something stupid and basically taking the whole market down. So that's how I would look at it. Short term, 3%. Make sure you've got a reason why you're buying this. This is an accumulation phase. If I'm swing trading this, or I'm looking for a swing up over the next, say, 5 or 10 days, I accumulate my position, I build a position in this, and then I buy it when I feel like it's very accumulated or a good opportunity to buy in at a good price. I got history in this area. It's above my trade trend line, 15-day period moving average. I buy in. I put my 3% trailing stop. It's moved up. I'm covered. I've made money. Now, if you're long term, you did the same thing, same process. You accumulated just as an institutional or a hedge fund would do. They're accumulating shares here. You get your max position. In my case, a max, if I'm running a 12 position portfolio, my max position is 8% in one company. Okay. Once I have accumulated my full 18%, and maybe I'm buying at 50 basis points or 100 basis points at a time, I accumulate and I put a trailing stop in here at 7%, and I let the market dictate how long I own it, and I use that trailing stop to protect myself. And as the stock moves up, the trailing stop moves up. That's how I would go about building a risk management process. Time frame is important, number one. Number two, how much are you willing to lose? Number three, how long do you plan to hold this? Are you a day trader? Are you a swing trader? Or is this an investment? And determine what that is and be married to that. If this is a long-term investment, if it moves up and moves around 5% swings in it, that doesn't matter. You got your 7% trailing stop, and that keeps you protected. But if you're like, I don't want it, if my deviation in this stock is more than 7% potentially, maybe I want to inch it down to 10%. But any thing beyond 10%, especially if you're really truly risk managing in a high volatile market like markets we see today, where headline news can move a market, a lot, you don't probably want to go more than 10%. That's my opinion. What I like is that 7%. For some reason, I like the number 7 and I like the number 12. Maybe it's 12 disciples, but number 7, whatever. But that's for me, that's how I determine it from a long-term investment standpoint. So that's how I put that in. Put in good till cancel. If it's a or short term or long term, good to cancel. Make sure you don't leave it for a day, because at the end of the day, that trailing stop expires, and that leaves you open to potentially a big problem. If you use a trailing stop, put it in for good till cancel, as GTC is it referred to, and then it won't expire. Typically on most brokerage platforms, it won't expire for at least 90 days. And what you may find is, if you're more of a intermediate to long-term investor, is that you watch this move up and you see this behavior of accumulation, move up, accumulation, move up. At some point, something may change that you go, you know what? I'm going to tighten my trailing stop from, say, 7% to 5% or to 3%, because you have a reason of high probability that the stock is about to turn, as we've seen in the past, and you don't want to lose 7% of those profits you've made, but instead you'd be comfortable with 3 or 5%. So that's how I would approach stop losses. I'd use trailing stops, determine my time frame, put in my stops and the percentage I'm willing to lose. If it's a short-term trade, maybe 3%, maybe at the max, maybe 5%. When you get it below in a short-term perspective, you start to eat away at your capital real quick over 5%. Long-term standpoint, 7 to 10%. That's how I look at it. But you have to determine that. So determine how long you want to do that, how long you plan to own it. If this is once you've determined that, determine how much you're willing to lose for that period of time if you get stopped out, and place your stops for a trailing stop, good till cancel. Make sure to do good till cancel instead of a day trailing stop. So that's how you do trailing stops. That's how I would risk manage around this, and that's how I do it. So I hope you enjoyed the video. Hit the like button, hit the subscribe button, join us on the Morning Edge, sign up for Platinum or the premium channel, a gold channel. Great value. We talk about this stuff all the time, and it's a great forum for you to become a better investor. Have a great day, and always, always live loud. See ya.